Cool. So let's jump right in. So our client for today's discussion is called Happy Mart. Okay. And Happy Mart is a well-established convenience store chain based in Thailand with a strong presence in urban areas across the country. Happy Mart operates over 300 stores and has been in operation for over 20 years. The company has experienced steady growth over those years and currently holds a significant market share in the region it operates within Thailand, but it is facing declining revenue and profit. The CEO of Happy Mart has engaged us to help in defining a turnaround strategy for the company. How would you get started?
Great. Well, first, thank you so much, Eli, for presenting this case to me with regards to our client, Happy Mart. I have a few clarifying questions, but first I just want to kind of walk through my notes just to make sure we're on the same page. So our client is Happy Mart, a convenience store chain in Thailand, predominantly in urban areas. So they've been in business for over 20 years and have built over 300 stores and have experienced steady growth and have gotten to a point where they have a strong market share in their location or specified locations. But the problem we're dealing with today is a decrease in revenue and a decrease in profit. So we're looking to figure out what strategies we can implement to kind of turn things around. Is that correct?
Exactly. I'd say that's a fair assessment, recap.
Okay, perfect. And so my first question is, in terms of getting this turnaround, are we trying to kind of break even by the end of this year? Or like, what's the metric of success for turning things around?
Yeah, so the case doesn't tell us exactly what their profitability is now. So we would definitely want to reverse the direction. So all we know that it's declining, and we know that the key metric of success would be turning around the direction. Okay, so we don't know exactly at this stage, are they profitable, are they not, do they need to break even, but we do know that the profitability trend line is negative, and success would be to turn that the other direction.
Okay, all right. So we need some sort of intervention to get us back to an increasing revenue, increasing profit. Okay.
Yeah. And what other clarifying questions do you have?
Do you have the exact market share percentage for Happy Mart?
Yeah, so we have a bit of information on their market share, which we'll get to in just a second. But you can assume that, I'll give you some broad brushstrokes just to get you started. You can assume that they are strongest in Bangkok, where they have a 10% approximate market share. Bangkok being the capital city of Thailand. And you can assume that their market share in the rest of the country, so ex-Bangkok, is going to be negligible right now.
Okay, gotcha. All right. And of the 300 stores, what percentage of them are located in Bangkok?
So you can assume, that's a good question. You can assume that for the sake of argument that 100% of them are located in Bangkok right now.
All right. Let's see. And so you said this is a convenience store chain. So kind of like low mid-market is kind of the population that we're targeting?
Yeah, you can assume that customers want cheap prices. So they're price sensitive, but they also require a nice, bright, clean premises and a wide assortment of products in convenient locations.
And what products do they sell at the convenience store?
So you can imagine, I would say, to give you a benchmark that might be closer to home, you can imagine kind of a product assortment like a 7-Eleven that you would see kind of in the United States.
Gotcha. Okay, awesome. Thank you so much for answering my questions. I'm just going to take 1 to 2 minutes, no more than 2, to sort of structure my thoughts and figure out what the best approach should be.
Great. Sounds good. Take your time.
Thanks so much.
All right. So I've taken some time to flesh out my thoughts a little bit. And I'm going to walk you through kind of what I'm thinking about, and maybe we can decide on a direction to go in.
Great. Let's hear what you got.
All right. So in the past 20 years, Happy Mart has seen steady growth, but now we're dealing with this decrease in profitability. So first, I want to look at why revenue has been decreasing. In terms of number of products are we selling less than usual? And then in terms of how much the products cost, are they priced kind of lower in the market? We're trying to understand the pricing schematic for those. And then not only is revenue decreasing, but you said profit is decreasing. So I want to understand and maybe do a cost analysis. So maybe costs have gone up over the years due to inflation or additional expenditures required for variable costs. So maybe maintenance requires a little bit more support, maybe personnel, there's a lot of turnover, or maybe the compensation structure is something to look at with respect to the personnel. And so after looking at revenue and then profit, then I think it would be important to do a market or industry analysis. So first looking at competitors. So was there a 7-Eleven substitute that came into the market that kind of disrupted things for Happy Mart? And then just overall the market landscape with respect to the population of the consumers, kind of like how has that population changed over the past 20 years? Are they still looking for this price sensible, wide assortment sort of establishment, or has the population grown to desire something else? And so I think it'd be important to understand what the end consumer goals and needs are as well. Does any of this stand out to you, or do you want to discuss any in particular?
So I just want to make sure that we're on the same page here. So I have 3 buckets. I'm hearing the first one is looking into why revenue is declining, which you would divide into basically price and quantity, or price and product. Then the second one is completing the profitability analysis by looking at the other side of the profitability equation, which is to say cost, external factors such as inflation, but also internal factors such as variable costs or expenses, operational expenses. And then the third bucket would be market/industry analysis, which then you've broken down into competitors and consumer trends, essentially. Okay. Which would you want to start with? Where would you, if this was your ingoing structure and you were on a team where this was your work plan, so to speak, where would you want to begin?
So since we've been experiencing steady growth over the past 20 years, perhaps I think my hypothesis initially could be that we've seen revenue growth, but perhaps costs have increased. So I would like to look at costs and see if there are any trends in that.
Okay. So I think, costs would be one area for sure, and the other area would be what you highlighted in your third bucket, which is kind of what's happening in the market. So let's start with that, and then if we get to costs, we'll come back to that. So let's start with the market overview for Happy Mart. And what I'm going to do is I'm going to share with you an exhibit that we got from the Chief Strategy Officer of Happy Mart, and she shared this market data with us. And I'd like for you to take a minute or two, look at the chart, and share the insights that you are able to glean from this chart with me. Okay, so I'm going to share this with you now, and feel free to take some time to look over it, and then get back to me in a minute or two with kind of your key insights or takeaways from the chart.
Okay, So I'll just take 2 minutes to read the chart and then analyze it. So yeah, just like you said, Happy Mart has 10% of market share in Bangkok and negligible market share outside of Bangkok. I was wondering if you could clarify the numbers at the top of the graph, the 500 and 1,000.
Is it? Go ahead.
Yeah, I'm wondering if they represent revenue. So of like if we took $500, Happy Mart would only be able to claim 10% of that.
So here, this is the total industry revenue. So you can assume that 500 million is, there's no million on the chart, but 500 million USD is the total revenue for this industry in Bangkok. And the net profit is 75 million. Yeah. Okay. Same thing on the right. So outside of Bangkok, let's assume that this is $1 billion. And that the net profit there is 100 million.
Okay. So the trend I'm seeing, it's kind of glaring at me, is that while Happy Mart is also a convenience store brand, the other convenience stores comprise of at least half, or take up at least half of the market share, whether it's in Bangkok or outside of Bangkok. And so I'm wondering if you have any information on how many other competitive convenience stores are represented by this graph.
So we don't have the exact numbers, but I think you're definitely on the right track. And I think what we're trying to do here is sort of identify the trends or the themes that are emerging between both Happy Mart and competitors in Bangkok versus ex-Bangkok, without maybe knowing exactly how many outlets there are.
Okay. And so in terms of consumers looking for price sensible, clean, wide assortment products, is it safe to say that the pharmacies, hypermarts, all these other stores are active competitors for Happy Mart, or of Happy Mart?
Yes. Mm-hmm.
Okay, gotcha. So in terms of speaking only about Bangkok, so it looks like the other convenience stores kind of dominate outside of Bangkok, not allowing Happy Mart to kind of disrupt that market. So one of my hypotheses is that perhaps any efforts outside of Bangkok might just be losing money. So focusing on Bangkok would be ideal in this situation. The growth rate is smaller than outside of Bangkok, but the market share is only evident in the Bangkok region for Happy Mart.
So let's go a bit further on that. So what can you tell us about the profitability of the different geographies from the data that we have in this chart?
From the data that we have in this chart, the net profit for ex-Bangkok is $100 million over $1,000 million.
You don't worry about the zeros. You can just do the math with the zeros that are here, because percentage wise it'll be the same. So you can save yourself the zero headache.
Okay, thanks. So about 10% of or that profit margin is about 10% for outside of Bangkok. And then for within Bangkok, we have about 15% for, sorry, 15% period, in terms of profit margin for Bangkok. So it's more profitable to engage in the Bangkok market. And like, it would make sense why all of Happy Mart's convenience stores are located there.
Right. So if you were to summarize kind of the key messages of what we've discussed so far in this chart, what would be the kind of 3 key takeaways that you would want to share back with the Chief Strategy Officer of Happy Mart who gave us this data?
So this chart is communicating that there isn't much of a presence or opportunity for Happy Mart to engage outside of Bangkok because they have a negligible market share in other regions of Thailand. Even though the growth rate for ex-Bangkok is higher than that of Bangkok, the profitability in terms of the profit margin is higher in Bangkok. So Happy Mart definitely has an opportunity to kind of deepen their influence on the market in Bangkok.
Okay. So the Chief Strategy Officer came back to us and she basically said that the problem with Bangkok is that it's saturated. It's saturated and as we saw in the chart, it's highly fragmented. So it's very unlikely that we will be able to find the opportunities we need in Bangkok to be able to, as they say, move the needle, right? So if you fast forward the tape a few months, discussions have progressed to discussing Happy Mart's expansion strategy outside of Bangkok, okay? And the Happy Mart executive team has identified Phuket as the next city for Happy Mart to expand. And they've shared some store level data with us. Okay, so fast forward, we know that Bangkok is saturated. And as you correctly mentioned, it is more profitable if you look at the margins. But in terms of saturation, it's also highly saturated and therefore we'll need to look elsewhere. So I'm going to share with you another exhibit. Okay, and what I'd like for you to do now is to share with me the insights that you can gather from the following exhibit that is regarding the opportunity of opening a store in Phuket. Okay, so that's coming up right now. And you're welcome to take a minute or two to look at this. You're welcome to write down any numbers and let me know how you wish to proceed.
So I'll just take another 2 minutes to read and jot down some notes.
Go right ahead. That sounds great.
And the average transaction value per customer is $2 per visit.
That's correct. $2 per customer per visit. Mm-hmm.
Okay, wonderful. And we're like, okay. So given this exhibit, I'm looking at 2 things, kind of like the fixed costs and then the variable costs. So in terms of the fixed cost to open a new store in Phuket, is that correct?
Is it?
Okay, to open a new store in Phuket, that's gonna be about $500,000, which is 500 square feet per year times 1,000 square feet. And so per store, it will cost at least $500,000. So we are at that's the cost to open the new store. And so I think next I want to look at the variable costs, which are based on the revenue, so then we can calculate revenue. Given that average transaction value per customer is $2, per visit and we get per customer. I'm going to multiply this $2 by 1,000 or 100,000 per month. Do we have any data on how many visits the average customer makes in a month?
So for convenience stores, they do not track individual customers. There's no loyalty program and there's no way of knowing who is visiting. A lot of the transactions are cash based. So you could assume that each visit is a unique customer, even if it's the same person, because there's no way, they don't have any way of knowing. You know, you could come in and buy a coffee in the morning and then the next day you could come in and buy a donut, but they don't know that it's love. You know, they just know that someone else came in.
Okay, gotcha. So let's see. So we have $2 per visit per customer. And then I'll multiply that by 100,000 customers per month. And we want to look at the yearly cost, correct?
Is it?
So then I'll multiply that by 12 months in 1 year to get the annual cost. So then that will give me 2 times 100,000 is 200,000 times 12 is going to be 20. So about $2.4 million is our annual variable cost. Is our revenue for the year?
So you're very close. There's one important assumption that I think you may be missing, which is that 100,000 number is the estimate for Bangkok. So the 100,000, 50% of that. So you can just do a 50% haircut on the number that you just got. Exactly. So 1.2 million would be our projected revenue per year from the store in Phuket. Mm-hmm.
Okay, so then our fixed cost is 500,000. So that's minus 1.2 million in revenue minus 0.5 million for our fixed costs. Then we have our variable cost, which is half of the revenue. So that's about 0.6 million. So we're subtracting that from 1.2 as well. And so I know that $500,000 or 500,000 and 600,000 make about like 1.1 million. So subtracting that from 1.2, we're getting 0.1 million or 100,000. So our net profit is going to be $100,000 if we open up one store in Phuket.
And how about our margin? What is our margin looking like on this store? Because what they'll be curious to know is how it compares to our current margins.
So our current margins in Bangkok are 15%, and our current margins outside of Bangkok are 10%. So if we take our net profit, which is $100,000, divide that by 1.2 million, we get, which is 1/12. Sorry, I didn't say that out loud. But that's going to be a little less than 10%. So,
can you get a little bit closer? Can you get a little bit closer for me? Not closer to the microphone, closer to the number. It will. You are correct. It will be less than 10%. That is, as we would say at McKinsey, directionally correct. But can you get closer to the exact answer for me, please?
Of course I can. I would be honored and delighted to. So that will be about 9%. Or you want an exact?
So that's pretty close. I think that's close enough. It would be the correct answer is 8.3 because we're looking at, as you correctly pointed out, $100,000 for the store in Phuket as the profit, and the total revenue on a total revenue of 1.2 million.
Okay, so we're looking at 8.3% as our profit margin for opening one store in 1 year in Phuket.
Correct.
Okay. That is lower than the profit margin we would expect outside of Bangkok.
It is. So what can you imply? What would you advise the management team on now that you have some of these numbers? What would be your guidance after performing this analysis?
So we started with 20 years of steady growth for Happy Mart, but with a strong market share in Bangkok. But we've been seeing a decrease in revenue and decrease in profit. So based on the analysis that I've performed, we have found that there is a 15%, or the profit margin is 15% in Bangkok and 10% outside of Bangkok. So it would it would seem like Bangkok would be the way to go, but because the market is highly saturated and highly fragmented, we're thinking about exploring, or it would be wise to explore outside of Bangkok. So Phuket was mentioned, and we did an analysis of costs and revenue to get the profitability of opening a store in Phuket. The profit margin is less than what we would expect at about 8.3%. So in order to kind of turn things around to go from declining profit, or like declining profitability, to a climb in profitability, I would look into the possibility of expansion in terms of mergers and acquisitions. So maybe partnering with the other convenience stores and kind of creating a synergistic relationship such that we can use what's already available in the market to drive our revenue growth. So looking at the top performing convenience stores and seeing if we can acquire those or merge with them, I think would be a good strategy.
Okay, great. Cool. Well, thank you for that, Love. And that brings us to the conclusion of the case today. So very good job. It's always difficult to do under pressure, and especially with an audience of 100 people, which will not be the case in real life. So very well done. Before we debrief, though, go ahead.
Sorry, I just wanted to add
Go ahead.
very quickly. One of the risks of doing this could be brand perception might be affected if we're working with another and like another enterprise. So it would be important to make sure that the company that if we do merge or acquire, that it aligns with our brand.
Very good. Noted. Thank you. Cool. So how did that feel?
I am incredibly sweaty, but I feel challenged in a way that I haven't necessarily been in my case prep experience. The numbers were okay. I think kind of the open-endedness was a little stressful. But yeah, thank you so much for your time. Thank you for working on this case with me.
You're welcome. So what I'd like to do is I'd like to go through the different parts of the case, and I'll let you decide. Do you want to go beginning to end, or should we start at the end where we just were and work our way backwards? What would be most helpful for you in terms of processing the feedback?
Beginning to end, please.
Beginning to end. Okay. So the beginning, as you know, and as everyone knows, is all about structuring. Okay. And this is where you want to make sure that you have your 3 to 4 level 1 buckets, your level 2 buckets, and then you give some examples on level 3. So here, I think your buckets were revenue, cost / profitability, and then market / industry analysis. What I would have done here, and I would say what you did was pretty close. What I would have done here, how I would have bucketed this, is some version of the 3 C's framework, right? So company, customers, and competition. Because I think that your revenue and cost and profitability buckets can actually all be merged into a bucket that you could call financials or company financials, if you will. And that's where then you have your revenue and cost categories under there. Your competitive questions could then be, as you correctly said, who are the major competitors? One thing you didn't mention, what have they been doing recently? Are there any moves planned? And then how are we different from competition? Or is it completely homogenous? Are we separated? Do we have some sort of elements of distinctiveness, and what are they? Is it customer service? Is it location? Is it whatever? And then on the third bucket, customer, really understanding who are our customers, what do they value most when they decide which store they're going to visit? And are there any other segments that we're not currently targeting that we could attack? An optional area to investigate, which you could include from the beginning, is this whole idea of growth, which I think you started to talk about more when we got to the end. But you are welcome to have a separate bucket that is, growth or mergers and acquisitions, which is, can we look at merging or acquiring, attractive targets in this space, or whatever the case may be, right? So kind of a 3, possibly 4 bucket structure, pretty close to what you have, but I would have included revenue and costs under the same bucket of company financials, and then have competitors and consumers in their own little buckets. Cool. On the second part, which was around the fragmentation and the breakdown, I think here sort of the big takeaway, and you got most of them, was basically about Bangkok being fragmented and saturated, us not having any presence outside of Bangkok, and also the fact that the margins were different in both places. So I think you did a good job there. I think my major comment on the part that immediately followed that, which was about the kind of basically what you were doing was calculating the P&L of a Phuket store for a year. The part that was really the most important part there to realize was that this 8.3 or 9% margin that they could expect in Phuket is going to be margin dilutive, meaning they're used to a much higher margin than that. And so the question here really becomes to the CEO, are you trying to grow your revenue and profit in dollar amount? Or are you trying to increase your margin or maintain your margin and your profitability in terms of percent? And this was an important nuance that we didn't quite get to. But this is, I think, for me, the margin dilution point is, I think, the key thing that separates a very good performance, which is what you gave with maybe a distinctive performance, is having that element of margin dilution there and saying, hey, you need to think about your priorities, Happy Mark, because if you're just looking for growth, you have to get out of Bangkok, but you need to know it's going to cost you margin, even though it's going to be adding to your revenue and your profit overall. So I think that would be the big thing there. And then I think on the final question, where I asked you to synthesize your recommendation for the top team, there you're welcome to ask for time, by the way. And I think you should feel free to ask for time at any point in the case, including the very end, to gather your thoughts. And then you take, maybe 45 seconds to a minute. And then when you come back to it, you try to be a bit more brief, a bit more succinct in terms of, top down, these are the 3 points. These are the risks, and that's it. Right. So those would be my key feedback points. I think you did a great job throughout and a great job on the math as well.